Hello everyone, this is Christian with Rana Property Group, and today I'll be walking through our multifamily acquisition model. But before jumping into the model, I'll share a bit of background about who we are and what we do at Rana Property Group. So Rana Property Group is a real estate investment consulting firm that specializes in creating institutional grade financial models, investor presentations, as well as supporting capital raising initiatives, both on a deal by deal basis as well as programmatic raises. So if you're looking to raise your first fund. To date, we have supported over $1.5 billion in commercial real estate transactions in the US as well as globally and across all major asset classes. But even apart from that, we've also supported transactions and have really gotten into the weeds with several sponsors that specialize in self storage, manufactured housing, and other specialty asset classes. What really makes us stand out is that we also serve as an extension of your existing infrastructure in the sense that you can regard us as your fractional deal team. And what that means is that all things related to financial modeling, pitch book creation, asset management, Rana Property Group embed your existing infrastructure, and we act as a false multiplier, allowing you to execute with surgical precision, enhance your capital raising initiatives, and improve your overall institutional polish. So whether you're an emerging sponsor still doing your first few set of deals, if you're a solopreneur looking to build capital markets relationship or get funding for your first deal, or you're an existing platform that's already robust but still needs additional capacity without the full-time overhead, we exist to bridge that gap for you. So our mantra is we believe in democratizing institutional quality real estate. And again, to date, we have supported over $1.5 billion in real estate transactions since our inception in 2021, and we continue to do so with increasing velocity. So now we'll jump into going over the model. So here we are looking at the summary page, but actually before jumping into that, we'll take a look at the model infrastructure. So we have these tabs down here, which are pretty self-explanatory, but the color coding signals that these tabs are meant for input. So there are inputs on these tabs, which will drive the outputs for the model. And so we have the summary tab, unit mix, revenues, expenses, CapEx budget, and where you can input your SOFR curve for your debt projections. And then we also have partnership returns at the very end, and you can change the inputs here, which will inform your distribution waterfall outcomes. And so starting off with the summary tab, we have property information in the top left here, followed by investment assumptions, and then we have acquisition financing assumptions. So the objective of this model was to create a multifamily acquisition model that not only covered core acquisitions, but also fit the use case of value add models. And so in particular, under acquisition financing, you can choose the advanced type. So you could size a loan based on LTV or loan to cost. So if I click this drop down and select LTC for loan to cost, the model has updated accordingly, and we see that the acquisition loan has updated here. And if I set it back to LTV, the acquisition loan has updated again, and the rest of these sources and uses table. And so we have our corresponding assumptions for each of these, for these different sizing types. And so here we have LTV is set to 70%. We're currently looking at the 70%. We're currently looking at LTV. So if I change this to 50%, for example, and we want less leverage, that will flow throughout the model like so. And then I can always set that back. We'll set it to 70. We also have the functionality to include an interest only period. And we can make our debt assumptions really here based on the LTV sizing. If we go down here, we have the loan to cost sizing, and then we have similar inputs here. With loan to cost, we're assuming that the interest is capitalized each month, so PIK, payment in kind, and that is how that flows. And then we also allow for the rate type, so we can choose between a fixed interest rate or a floating rate, also known as a variable rate. And we have the interest rate index here, which is SOFR, which of course, if we were to click to this tab, this is where you input your SOFR curve, and this will flow throughout the model. Moving on, with this model, we also incorporated preferred equity assumptions. And the reason why we did that is because, quite frankly, given the uncertainty around tariffs now and different costs and what lenders are willing to do, we wanted to we wanted to have a more robust capital structure optionality here, and so we included preferred equity. While this is called preferred equity, really it functions the same as mezzanine. So if you wanted to change this for a specific use case to mezzanine, it will function exactly the same. Finally, here we have permanent financing assumptions in the event that this is a value add deal, and that's what you're underwriting, and you have bridge financing in the case of the acquisition loan. You, of course, can navigate to the permanent financing section and you can select whether or not you want to refinance. But in the case of bridge financing, if you were to refinance upon stabilization, we have that here. And rather than tying the the refinance month automatically to the stabilization month, what we recognize is that sponsors want to underwrite a potential buffer of when the property stabilizes versus when they're able to obtain financing, just because there's a little bit of uncertainty around what the Fed is going to do with rates. We thought rates would have been cut a few times now, but the Fed decided to hold them steady. And so we wanted to build in that functionality here. And then also with this, with the permanent financing assumption, we have the NOI method capture methodology. So we can choose trailing 12, trailing 3, in place, or forward 12. And so depending on how lenders decide to underwrite your deal, you can seamlessly get a glimpse of what they how they may approach your deal. So again, we have these different options here. So if I were to change this to trailing 3, assuming the cash flows have been growing in a stable fashion over the past, have been growing consistently, obviously this will be a more conservative approach. And then, of course, what we also, I'll set this back to in place. And then, of course, what we also decided to do was have the 3 different loan stipulations that you typically will face when pursuing a refinance. So if that's part of your strategy, we wanted to make sure that there is no guesswork here. So you have the optionality to input a minimum debt service coverage ratio, a minimum debt yield, and then a maximum LTV. So you have these 3 stipulations. And of course, the way the model works is that the permanent financing proceeds will be calculated as the most conservative version. So the most conservative output rather of these 3. So in this case, we see that the corresponding loan amount for the minimum DSCR stipulation is 29.4 million. That's the lowest amount. So the permanent financing proceeds that can be issued, the maximum amount that satisfies all of these criteria is this 29.4 million. And then beneath this, we have our loan assumptions for this permanent financing amount as well. So the interest rate, we also have the optionality rather, for an interest-only period, amortization, maturity, loan origination fee, and then exit fees as well. That pretty much covers everything for financing. So we'll move on to the scenario selection. So again, what we did, because we are building these models not only to be tools, but in response to the concerns that many of the sponsors that we work with, particularly developers, are concerned about, is again, this uncertainty around tariffs and how that is going to impact the economy. So what we wanted to underwrite here was we wanted to showcase different case selections. So whereas most models will have you input the assumptions, and in many instances that may be able to get you to the finish line, get you the level of granularity you need. We wanted to add even more granularity by having this case selection assumption. So here we can toggle between a downside, base, and upside case, and this will flow seamlessly through the model. These assumptions here will remain unchanged, but things as mentioned here, key line items such as purchase price, closing costs, stabilized market cap rate, these sort of things will fluctuate. We have our sources and uses table here, which is pretty self-explanatory, but then we also have our CapEx budget. And since I just covered the scenario selection, I'll jump over to the CapEx budget tab, because we also see that our scenario selection, as we toggle, will flow through here. So as I change to, let's say, for example, from base to downside or base to upside, this will flow through to our CapEx projections as well. And so just like with a development model, we have the main CapEx budget category. So we start off with property purchase, then we have the hard cost, soft cost, and then in any prudent underwriting, we're also going to have our contingency, which is down here. And then if I scroll over to the right, we have the functionality to change the projection type. So we have the projection type here is currently set to bell curve, but this can be changed to straight line, meaning that if you have $1,000,000 in development costs or hard costs for a particular line item, divide that by 12, it will incur $83,000 approximately per month, whereas bell curve in the middle of that 12 months, so let's say months 6 through 7, then there will be the cost expense will be greatest in that time. And then we see here we also have checks built into the model to make sure that we're accounting for every dollar in the development budget. So jumping back to the summary page, we have project milestones. So some of the key milestones that you would expect in a value add deal. Of course, if this is acquisition, especially a core one where you're not identifying any impairments and looking to add value to them, then well, particularly for value add, this is going to be useful. For core, not as much, but we left it in here, or rather we included it in here just to provide a high level snapshot of how the deal is evolving over time via the key milestones. Beneath this, we have the unit mix, but I won't dwell on this too long because we will come back to this. There's a tab devoted to this. And so we get over to the right here and we have the summary section. So here we have a pro forma snapshot. And so here we can look at the stabilization month, the refinance month, and then the sale month. The sale month is informed by what we have here in the scenario selection. The refinance month is informed by the schedule that I showed in the bottom left of the summary tab, where we can choose our refinancing assumptions. It wasn't scrolling. So down here, and then stabilization is something completely separate, which I will get into on another tab. And then again here, we can choose our NOI method, and we can also do so for the refinance and sale instances. And so here we'll get a sense of the property value at this given point in time. And then we have some summary metrics here. So cash on cash return annualized, the permanent loan DSCR, and then the permanent loan debt yield as well. Finally, we have the disposition summary, and this is going to be directly informed by the purchase price plus any capex, and then the sale, and then that's how we calculate the change on a dollar basis and a percentage basis. We have our return summary here. And so we have unlevered return. So this is on a capital structure neutral basis. More simply stated, this is without considering the effects of debt. We of course have the levered basis, which considers the effects of debt. So all of these assumptions here regarding our loan sizing, our different loan stipulations, and things of that nature, that informs our levered returns. Then we have our GP and LP returns, which is going to be informed by our assumptions in terms of profit sharing, which particularly will become more clear as we visit the partnership returns tab. And then finally, we have some key metrics. So profit, of course, we have our equity multiple and then our IRR. And then beneath that, we have a stabilized return on cost and then our development spread, also known as development yield. And then we have a graphic that shows that nice and clear whether this deal is lucrative or not from a development spread standpoint. Here we also have a sensitivity analysis, and so we can we can determine how our sensitivities, what the output for a sensitivity table would be by changing these inputs here. And so now we can navigate over to the unit mix tab. We'll hit Control Home. And so here, this is pretty self-explanatory. We can input the different units that will be at the property, up to 10 unit types. You can do as many units as you would like, but you can input up to 10 different types. And then you can input the number of bedrooms, bathrooms, the percentage breakdown compared to other units, square footage, so on and so forth. And then what we also did was incorporate comparables, because especially when doing value add, again, that is one of the key functions of this model. You, of course, are going to the amounts of capex that you're willing to put into the deal is, of course, going to be directly informed by what you think you can achieve for market rents. And so here we have our asking rent, we have the optionality to include concessions, and then we have summary statistics, namely the minimum, median, average, and max. And this is for the different room types that we input into the unit mix there. And so those are rent comparables. If we scroll over even more to the right, starting in column AA, we have sales comparables as well, which of course can be pulled and then inputted here from CoStar. And so that's what we have for our unit mix tab. Next, we have the revenues tab. So the revenues tab is going to show how the deal is evolving over time. And so in particular here, we have our unit mix, which is a summary of the previous tab. But particularly the reason why this is coded with this, why this tab is colored with this light shade of blue is because we have the optionality to input the leasing schedule. So we choose when the lease up start is, the lease up period, when stabilization occurs, and then we have our starting occupancy, ending occupancy, and then additional vacancy if there is any renovations going on and you want to assume that additional units are vacant during that time, you can change this value here to 5%, and then that will reduce the occupancy by 5% during this duration that we have here. So this lease up period of 18 months. And then finally, we have other income. So this is meant to account for your ancillary income. And we have application fees, parking income, amenity income, so on and so forth. But we have placeholders here for additional inputs. And then if we scroll over even more, we have revenue escalations and revenue adjustments. So you can get granular for years 1 through 4, and then years 5 and beyond will have the same rate. Usually sponsors are underwriting the first 5 years, even if it's a 10-year hold, but most of the value add or your investment strategy is going to occur in these first 5 years. So we have that incorporated. Beneath this, we have, of course, our revenue adjustments, so vacancy, collection loss, concessions, and other loss. And of course, this will reduce your top line gross potential income. Before I transition, we have our in-place rent schedules going on down here, and this should be pretty straightforward. So if the property stabilizes in month 23, if we shift over to month 23, we see that we're at 95%. The property is growing. And again, this is going to be informed by these assumptions that we have here, depending on the lease up start and the lease up end. And so that's pretty much it. That's pretty much it for this tab. This gives you a breakdown of the revenue tab. So rather than have this be sort of a black box that feeds just into perhaps the monthly or even annual pro forma cash flows, we wanted to have these supporting schedules here so you can audit the model and make any changes you want to the lease up assumptions as well. So next, navigating over to the expenses tab. Similar to in terms of layout, it's very similar to the revenues tab. What is different here is that we, of course, are showcasing expenses. So we have our expenses here on a dollar per unit per year basis, but this can easily be switched by changing the model mechanics, for example, to look at things on a dollar per unit per month basis. This really varies from sponsor to sponsor. But what we did here, which is again meant to add an additional layer of granularity that we believe adds meaningful value without turning the model into something that's too difficult to understand, is we have the flexibility to forecast expenses based on the percentage of the expenses that are variable. So for example, insurance is going to be fixed, so the variable percentage is set to 0, but something like utilities is going to grow in tandem with the property occupancy, but there of course is a fixed component. So we have the functionality for that built in here. And then we have property tax, which is forecasted on its own for obvious reasons. But particularly if there's a reassessment that's triggered, you can showcase that here. Or if you just want to assume a run rate, a more simple assumption, you can do that here as well. Unlike with the revenue escalations and the revenue adjustments for property tax, we did extend this all the way out for 11 years. And then finally, we have RUBS income. So this is our a reimbursement of utilities, which will tie directly to the inputted utilities expenses here. But this will of course be offset by the RUBS income that will be experienced here. Let's actually, so we have that. And so now we will navigate to the CapEx budget. And I covered everything I need to here, so we'll move on. The SOFR curve, this will inform the financing tab, but here this is just the inputs, and you'll get your curve from wherever you decide to get it, input it here, and this will flow throughout the model seamlessly. So now we navigate over to the monthly cash flows, and then this is our first true output page. And what you see here is the pro forma just on a monthly basis. So this is the operating statement for the property. And if we scroll down, we'll see net operating income. We'll see the development costs. And then as we navigate to the bottom here, we see our return summary. And really here, again, we wanted to build a robust model, but we didn't want it to be too difficult for somebody who didn't originally build a model to understand. We have the different cash flows associated with the different loan sizing scenarios here. So for avoidance of any doubt, if you're questioning how the model is calculating, you can just navigate to this tab and see that, okay, we're clearly looking at an LTV acquisition loan sizing scenario because all of the cash flows are showing here, whereas the acquisition loan LTC sizing scenario, nothing is showing here. And again, we just want to make sure that our models are robust, but we don't want to give up on the readability and general understanding. Because again, to the extent that you are circulating this with people outside of your organization, to prospective LPs, for example, we don't want to make capital raising any more difficult than it already is. So next, we'll navigate over to the annual cash flow tab. And this is just the monthly cash flow tab, but of course shown on an annual basis. And so we have this here. And if we scroll down to the bottom, we see the same return metrics. We navigate to the financing tab. We see our development cost here. And so we have our equity draw schedule. In the event that you decide to use the bridge financing, the LTC sizing methodology, you can come here and this will instead default to doing equity draws where the equity is deployed first before drawing down on any debt. And then we have our preferred equity section here where we can see the sizing that corresponds to that, the acquisition financing here as well. We have our interest rate projections. So here we see that it's set to 8% because we've decided to set the interest rate to fixed. But if I navigate to the summary tab, I can of course change this to floating or variable. And then finally we have permanent financing. And this is just showcasing some of the metrics associated with that, namely the debt yield, interest coverage ratio, and DSCR. Finally, we have the amortization table, and this corresponds to the permanent financing. Again, this is showcased here, but some people do prefer to see it in a vertical layout. And then the added benefit of this here is that it's also calculating the balloon payments. And then finally, we have our partnership return schedule. And so this is particularly important for those of you who are looking to raise equity in the form of LP equity. This will allow you to delineate exactly what the returns would be. Again, the purpose of financial modeling is to make an investment, is to highlight any potential pitfalls in an investment and find ways to mitigate those risks. And so here we are showcasing, we're looking at a pari pursuit waterfall, which means that in the preferred return hurdle, cash flows will be distributed in proportion to the equity commitment. But then beyond that, this is where the hurdle structure comes into place, where we have GP promote, and then we have checks built into this. Again, the model is fully auditable, so you can scroll down and see the preferred return cash flows, tier 1, tier 2, tier 3, and then finally our catch-all tier, tier 4. And then we have our checks here, our IRR checks, because this is an IRR-based waterfall. But on that point, if you wanted a different waterfall, we have several waterfalls. For example, hybrid schedules. We have waterfalls that have a GP catch-up if you are going toward a more institutional crowd. But this is great if you're looking for a more simple syndication. And then here we have more checks. Again, waterfalls can be fairly complicated, so we want to get rid of any doubt that the model is flowing correctly. And then we have our annual distributions here. So this deal is being exited based on what I inputted on the summary tab in month 60. Month 60, of course, corresponds to year 5. So we see that all of the cash flows are experienced and distributed by year 5, and we see nothing for years 6 through 10. And so if we navigate back to the summary page, again, this is where these returns are coming from. That is directly being informed by the partnership returns tab. But that's it for the model. There are so many things that can be underwritten in this model. Again, there's our NOI sizing method again. We have our GP equity contribution, which will flow through. But the point is, this is meant to be a tool that is suitable for a debt audience as well as potential equity, and is really meant to answer most questions that would arise in a capital raising process. This model is 100% built by Rayner Property Group, and it's just one of the many tools that we utilize to help the many sponsors that we work with in executing real estate deals more effectively and supporting them in their capital raises. But thank you everyone for watching. If you would like to begin a formal engagement with us, you can reach out to us at raynerpropertygroup.com, or you can email me directly at christian.rayna@raynerpropertygroup.com. And my contact information, as well as general information about Rayner Property Group, RPG, will be included in the description of this video. Thanks, everyone.